If someone came up to you with a check, let's say with quite a few zeros on it, and said they wanted to buy your company, what would you say? Would you immediately jump at the offer or be highly resistant? And what numbers would make you say yes or no? Today, I want to talk about how to think through that question and also look at when you might want to be reaching out for an acquisition. And I'll use as an example the sale of my company, Anonymizer. Greetings, founders. Welcome to Feel the Boot, the science of startups. I'm your host, Lance Cottrell, and I'm here to help you navigate the torturous path from starting your company through a successful exit. Now, I know what it's like. I've been there myself, and I have helped countless other founders along their journey. If you're running a high-growth company targeting a big exit, then there's really two win conditions and two loss conditions. On the win side, you can have an IPO. Awesome, big win, really unlikely to happen. Or you can have a successful acquisition that ends up giving a good return to absolutely everyone. On the loss side, obviously you can just crash and burn, or you might end up limping along in an almost undead state for some indefinite period of time. That's pretty bad. So in the context of those four possible outcomes, how do you decide whether or not you should sell the company, be acquired right now at some particular price? When you're thinking about any acquisition offer, you need to look at what does that bird in the hand look like versus the possible upside in the future. So how much money are we talking about, and what would that feel like to you? Is that a definitive win? If someone said, here's the money, you'd be happy to take it and hand over the reins on the spot. Or would that be really grudging? Or perhaps there's some prices at which you just flat out say no. But you need to weigh that against what is that upside. And on the upper end of the upside, maybe you're looking towards a potential IPO and billions of dollars. But there's also risk on that side, right? If someone's handing you a check, that's cash in hand. Maybe there's an earnout, and those terms really do matter in how you think about this risk. But if you want to stay and ride this horse for the whole journey, then what are the chances that something goes terribly wrong? What are the odds that a big competitor enters the space and just crushes you? Or you lose one of your biggest customers and suddenly you've got half the revenue you did before, and you're having difficulty making payroll. It's going to be a long time to earn out of that. And of course, once you get a big drop in value in revenues, then your valuations fall at the same time. And it can take a long time to climb out of that and get back to the sort of valuations for revenue that you had when you were growing strongly. Maybe there's also a risk of losing a key person. Do you have some engineers or scientists who are critical to the functioning of your business? And if they decided to start their own company or take another job offer, what does that mean for your company? So there's a lot of ways that failure could happen. And if you look at the odds, especially if you're maybe at the seed stage or not quite yet to your A round, the odds of failure are actually really pretty high. So even though there's some small chance of becoming a unicorn, there's also a big chance of having nothing in your hand. But the alternative is this check. I think of this a little bit like poker. Is this the right time to take your chips off the table? Because fundamentally, as founders, we're never making small bets. Almost all of us are playing all in for every hand. So let's look at my personal experience with this. I had a company, Anonymizer, that specialized in doing consumer privacy. We were a VPN provider before there were any other VPN providers in the world. And this grew to a reasonable size, generated some decent revenue, had a good sized user base, but started to cap out. We weren't continuing to grow. Fortunately, we discovered a new parallel business that allowed us to pivot. We started selling products to the US government for very high value boutique applications, and that was incredibly profitable. We made lots of money, grew the company, ended up in a situation where we had many millions of dollars in sales each year, all recurring SaaS revenue. We had $10 million in the bank, zero debt, and we're growing strongly. but not as fast as we'd like to. And part of the problem was we knew that we didn't have the expertise in this field to really be successful. I knew everything about consumer privacy, but I'd never had anything to do with the government or the intelligence community or the military or any of those groups. Now, we managed to get in there and do some sales, but as I've talked about before in other episodes, it's critical to really understand your customer. And fundamentally, we didn't. And especially in that environment, it's incredibly difficult to get that understanding unless you came from there. So we came to the understanding that probably the way to maximize our return and the growth of the company was going to be acquired. We thought about trying to acquire someone else, but there just wasn't anyone out there that had both the depth of experience in the government and skill set to be a really positive win-win combination for us. And the reality is, most acquisitions destroy value. On the positive side of the ledger for acquisition is we had taken very little investment money. We'd only brought in $2.5 million, all from angels, and so there'd been very little dilution, which meant that even a medium-sized exit could mean a life-changing amount of money to all the founders and a very strong return for all of the investors. At the same time, we knew that the risks we were facing were substantial. We had most of our income coming from just a couple of government customers. We had dozens of customers, but really about 3 of them represented the majority of our total revenue. And in the government, you never know when a contract is going to go away because there's been some reshuffle in the organization, some new priority pops out. Every couple of years, they rotate in a new boss and he wants to be the guy who's the superhero. So we knew the chances of one or more of these evaporating in the next couple of years, leaving us in a really tough spot, was non-trivial. So having decided that it made sense to sell the company rather than continuing to try to grow it indefinitely, we went out and hired some investment bankers to do a roadshow and put us up for sale rather than waiting for someone to approach us. Particularly because we were in such an obscure niche, it was unlikely that people would realize that there was an opportunity there at all. But when we went out to the market, we were unhappy with the valuations that we got. They were just not giving us much credit for the size of the market that we thought was out there. And so because we were in a position to do so, we said, no thanks, we're not going to take any of those offers. Let's go back and prove out that hockey stick. And so we took that risk. We decided that at that valuation, the risk, at least over the medium term, outweighed the difference in valuation that we thought we could get. And so we went back and continued to grow. And over the next couple of years, we did continue to hit those milestones that we were hoping to. And about 2 years later, went back to the market. And then, because we had more track record in this space, we did see the kinds of multiples we were expecting to get, and eventually took one of those offers. And importantly, it was an all-cash offer, so that there wasn't an earnout. We were not putting ourselves at risk. We were not assuming the risk of those customers doing something squirrely. We're saying, you're buying the company, you are buying that risk. We just want to cash out. And it turns out that was a really good and lucky choice, because within the next year, our biggest customer did in fact go away. And this was only months before Lehman Brothers and the whole economy collapsed in 2008, and all valuations tanked at that point. But we'd already locked it in. Sometimes it's at least as important to be lucky as smart. It's important to think about this acquisition question now and revisit it from time to time. Because if someone does suddenly show up on your doorstep with a large check, your thinking will not be the clearest, right? It's really hard to see past those zeros sometime, and the adrenaline will be running. You're much better off taking the time to consider it when you have the time and the leisure and can do it in a relaxed, objective way. And so you want to be asking yourself, and any other key stakeholders and investors, what kind of a number would be a definite yes? If someone came in with this, I mean, obviously you'd still try to negotiate a little, but if someone came to you with this number, you would take it at the end of the day and be happy and go buy a house on a vineyard or travel for the rest of your life or invest it in your next startup or whatever it is that you want to do. But that is going to go, check that box, that's in the win column, and on you go. Or is this just too early? Maybe you are fundamentally not willing to sell the business right now. Even if someone came to you with a valuation that's fundamentally stupid for your current stage, you'd still think, I want to go for a much bigger win. Maybe the numbers are just not life-changing enough to be worth jumping at, or there's something that you personally want to learn or accomplish in the company. And it's really important to be honest with yourself about that. So if someone comes to you with a deal, an offer, you don't waste their time or your time working through it, doing due diligence. You know this is not something that you're open to now, and you can just say no crisply. Make a list of the risks that you're going to face over the next, say, couple of years. What are the ways in which things could go wrong that would cause total disaster for your business, or that would take years to crawl out of the pit that they create? And think about what are the odds of any of those happening, because that's really the risk that you're avoiding by taking those chips off the table. At the other end of the spectrum, what is your hard no number? The number at which there's no possible way you would sell the company, you don't even want to negotiate or talk to them. It's good to have that absolute yes and absolute no number in mind. And then if someone comes in the middle, now there's opportunity to negotiate and try to get a better deal. Maybe think through your exact circumstances at that moment, talk to other stakeholders, but that's the area that you actually want to give this some serious consideration. This video is part of a playlist on running your business. All the videos contain information about the practicalities and logistics of running a startup. We also have playlists on a number of other topics, including launching your startup, fundraising, pitch decks, and founder insights. And you can find all of those over on our channel. Again, I'll put up a card. Thanks for watching this episode. If you liked it, give it a like. That tells the algorithm that you want to see more content like this, and it helps put this video in front of other founders like you. And helping founders is why I'm doing this. I also encourage you to leave a comment letting me know what other types of content you'd like me to create episodes about. If you've watched a bunch of these, I encourage you to subscribe and ring that bell so that you get informed every time new content gets released. It also tells YouTube that this is a useful channel and really helps us get in front of more people. I also encourage you to come and get one-on-one coaching from me. If you go to feeltheboot.com, our website, and sign up for the newsletter, in each letter I send out, there's a link to my Calendly to sign up for my office hours. Totally free, and I love talking to you founders. It's a blast. I learned so much about all the different kind of businesses you're pursuing. If you'd like to meet some of those other founders, I encourage you to come to our community, the Feel the Boot Founders Alliance. I'll put links to all those things down in the description. And until next time, ciao.